Hey, welcome back. I'm Adam Black, your lender for your life. And today we're diving into one of the most frequently asked questions. How can I get the best interest rate on my mortgage? Whether you're buying a new home or considering refinancing, understanding how to secure the best rate can save you a lot of money over the life of your loan. So let's get started. First off, why do interest rates matter? Interest rates significantly impact your monthly mortgage payments and the total cost of your loan over time. In fact, one survey shows that about 40% of consumers say that interest rate and loan fees are the most important factors when choosing a lender. But what about the other 60%? Factors like lender responsiveness, loan options, reputation, and reviews, these all play a crucial role in selecting a good mortgage professional. However, if the difference in interest rates and fees is significant, those other factors may not matter as much. Now let's talk about best rate versus lowest rate. When we talk about getting the best interest rate, it's not just about finding the lowest rate available. The best rate is the one that aligns with your financial goals and your circumstances. For example, let's say you're buying a $300,000 home with a 5% down payment. Lender A offers you a 6.5% interest rate with $1,000 in fees, while lender B offers you a 6% interest rate with $7,500 in fees. Which one's better? It depends on various factors, such as how long you plan to stay in the home and your ability to pay those upfront fees. All right, moving right along, what are some of the factors affecting your interest rate? Well, the first is obviously your loan terms. Shorter loan terms generally have a lower interest rate. A 15-year mortgage will often have a lower rate than a 30-year mortgage, but the monthly payments will obviously be higher because you're financing it for a shorter period. Number two, and another obvious one, is obviously your credit score. Credit score is a major factor in determining your interest rate. A high credit score typically results in a better rate. Aim for a credit score of 780 or higher for the best rates. Now, we've done a lot of videos in the past around credit and credit hacks and how to improve your credit. So make sure you go back and watch for those. And also make sure you hit the subscribe button so that you'll know when we post more of them. All right, number three is your loan to value ratio, or what we call in the business your LTV for short. This ratio is the loan amount divided by the home's value. A lower LTV can result in a better interest rate. Sometimes putting less than 20% down can actually get you a better rate depending on the loan program. The fourth thing, property type and use. The type of property and how you plan to use it, whether it's your primary residence, a second home, or an investment property, these can affect your interest rate. So condos, manufactured homes, and multi-unit properties often come with a higher rate compared to a single family residence. All right, let's talk tips for securing the best rate. Number one, and one that you're probably not expecting from me, shop around. While it's important to compare offers from different lenders, remember, rates can fluctuate daily. Tools like Bankrate and LendingTree, they can give you a general idea of where rates are, but they often are going to require you to share your contact information, leading to a barrage of calls and emails for you. Talk to friends and family. See who they've used in the past, give those people a call, interview them, see who you really get along with and who you feel like has your best interest at heart. Number two, evaluate your fees closely. Don't just look at the interest rate. Consider the fees associated with the loan. A lower rate with higher fees might not be the best deal in the long run. Me personally, I provide all my clients with what's called a total cost analysis, and I show them every option that's available to them. That way they can really see in clear to read columns what's going on with the mortgage and what it's going to cost them. Speaking of, don't be afraid to ask for a break-even analysis. Request your lender to calculate how many months it would take for the lower rate with higher fees to start saving you money. There's a break-even period out there, and you want to find that and make sure that you're not going to move before you've recouped that cost, or that you're not going to refinance before you recoup those costs. The fourth one, and one that is sort of an old wives' tale that a lot of people disregard, consider mortgage insurance. In the past, mortgage insurance was always really high, but in previous years, it's really come down. So if you're putting down less than 20%, mortgage insurance might seem like an extra cost, but it can sometimes help you get a better rate and lower your upfront expenses. Moving forward, always be willing to use online rate comparison tools. Online tools can be useful for getting a general idea of current rates. However, keep in mind that these are marketing tools. The rate you see advertised may not be the rate you qualify for once you submit a full application. So going back to the total cost analysis, make sure your lender can provide you a mortgage coach total cost analysis or something similar so that you can really compare things. All right, let's get into the final thoughts. Securing the best interest rate involves more than just finding the lowest rate available. It requires a comprehensive approach, taking into account your financial goals, your credit score, your loan terms, and other factors. Remember, I'm Adam Black, and I'm your lender for your life. And I'm here to help you navigate this complex process and find the best mortgage solutions for your needs. And if you found this video helpful, please like it, comment, and subscribe for more content. And don't hesitate to reach out for personalized advice. As always, thank you guys for watching, and I'll see you next time.